So it's another great time. Students, we meet again for this session of financial reporting and analysis. So we are going to do another question for consolidation. So already we have done around 4 questions, if I'm not wrong. So we have done around 4 questions. So, or we have done around 3. So this is the 4th one, and I will do the 5th, so that you can be able to finalize this topic of group accounting. So the question for today is November 2017, question 2. So the November 2017 question 2. So this is the relevant question, which was in that sitting. So they were saying that Mwanzo Limited, Safari and Upia operates in the clothing industry. The following information relates to the financial position of the 3 companies as at 30th September 2017. So you are given Mwanzo, Safari, and Upia. So you have the non-current assets, current assets, equity, and you have liabilities. So additional information, Mwanzo Limited acquired its investment as shown below. So you are told that he acquired Safari and Upia, 80,000 and 20,000 shares respectively. The cost of investment, 5,000, 1,600, retained earnings, 2,400 and 1,600. So you are told the date of acquisition of these 2 companies is 1st October 2015 and 1st October 2016. That is what you are told there. Number 2, as at the date of its acquisition, the fair value of Safari Limited's net assets were equal to the book value, with the exemption of land that had a fair value of 400 in excess of its book value. In excess of its book value. So what are they trying to test you on this additional information number 2? There's something I said last time called revaluation. So revaluation is the difference between the fair value of an asset and the relevant carrying amount. So obviously the fair value will be higher than the carrying amount by a certain figure. Or you can be told that the carrying amount was below the fair value by the relevant figure. Or you might be given the fair value, and at the same time, the carrying amount, you take the difference. So the difference will be your revaluation gain. Like now in note 2, you are told that the fair value of Safari Limited's net assets equal to their book values, with the exemption of RAND, that had a fair value of 400 in excess of its book value. So there was a revaluation of land. Number 3, on 1st September 2017, Mwanzo Limited processed an invoice of 100,000 in respect of an agreed allocation of management fees to Safari Limited. As at 30th September 2017, Safari Limited had not accounted for these transactions. Prior to this, the current account between the 2 companies had been agreed at Safari Limited, owing shillings 140,000 to Mwanzo Limited, included in trade receivables and trade payables respectively. Number 4, during the year ended 30th September 2017, Upia Limited sold goods to Mwanzo at a selling price of 280,000, which gave Upia Limited a profit of 40% on cost. Mwanzo Limited had a half of these goods in inventory as at 30th September 2017. Number 5, you are told that the fair value of the non-controlling interest in Safari was 1.5 million. So, obvious additional information number 5, this information will aid the parent company to know that it's supposed to use full method in the computation of goodwill of the subsidiary. Because for the parent to compute the goodwill of the subsidiary using full method, the minority shareholders, the NCI must be stated at its fair value. That is what we are provided in note 5, meaning that when we will be computing for the goodwill of the subsidiary, we have to use the full method. For number 4, it's all about goods which were sold from one company to another. Then the other company which received those goods, that company has not resold all of the goods by the end of the year. So meaning that we have to compute for the unrealized profit on stock. Because when Upia was selling these goods to Mwanzo, he sold at a selling price of 280,000, of which he made a profit of 40%. of those on those goods. But Mwanzo, the recipient, that is of those goods, has not resold all of them by the end of the year. You are told that half of the goods are unsold. Then for number 3, you have seen that there was an invoice which was being processed in respect of an agreed allocation of management fees to Safari. As at 30 September 2017, Safari had not accounted for this transaction. So we will have to account by reducing our trade receivables. So prior to this, the current account between the two companies had been agreed at Safari owing 140 to Mwanzo. So there was an outstanding balance previously, which was 140, and this amount, remember that it has not been settled by the end of the year, because they are saying that prior to this date, the current account between the two companies had been agreed at Safari Limited owing 140,000 to Mwanzo, included in trade receivables and trade payables. I said in consolidation, when there's anything which is outstanding between the parent and subsidiary, that is, if there's any outstanding balances between the parent and the subsidiary, and this amount has not been settled by the end of the year, we are not supposed to carry forward the balances to the next financial year, but we always forgo them. We always disregard them in the current period by crediting our receivables and debiting our payables. That is, deducting the receivables and deducting in the payables. So according to this question, you are told, yes, Mwanzo acquired Safari and Upia, but you are not given the percentage of acquisition. What they have provided is just what? The number of shares which were acquired in these companies. So you can be able to use the number of shares to get a percentage. That is what we did in our last question. Can you be able to do that? We can. So when you are not provided with the percentages, we use those number of shares to get the percentage. What you do, like now here you are told that Mwanzo is the one who acquired Safari and Upia. He acquired Safari and he acquired Upia. He acquired Safari and Upia. So you are told that in Safari, the number of shares which were acquired there is 80,000. In Upia, the number of shares which were acquired, according to note 1, is 20,000. So you can be able to use these shares to get the percentage. So what you do, you go to the statement of financial position. Statement of financial position, you check the ordinary share capital. The ordinary share capital of the two companies, Safari and Upia. And at the same time, you check the price per share. So if we check according to this question of ours here, there's someone who is unmuted, so unmute your mic if you don't have any question. So if you go to the ordinary share capital, you can see here we have 2,000. But remember that our statement is in thousands, shillings thousand. So this is 2 million and 1 million on the other side. 2 million, 1 million. Ordinary share of shillings 20 each. 20 each. So here we have 2 million. And here we have a capital, 1 million. So for them to raise, for example, 2 million, how many shares they issued? Per share is 20. And the per share is 20. So here we have, so this is 1 million. Is this 1 million? Or 100,000? Or 200,000 divided by 2. That is 100,000. So what about this? 100,000 divided by 2. This is 50,000. So now to get the percentage in Safari, you take the 80,000, the 80,000 they acquired, you divide the 100,000 times 100%. For Upia, you take 20,000, you divide 50,000 times 100%. What do you have for the first one? The percentage?
80%.
And for the second one?
40%.
%40. So meaning that this is 80% and this is 40%. And that one means that this is a subsidiary, this is an associate. This is a subsidiary and this is an associate. So this company, when the parent acquired these companies, our financial year was ending by what time? So our financial year started September 2017. It starts on 1st October 2016. So Safari was acquired when? 2015, the previous year. That is 1st October 2015. And Upia was acquired 1st October 2016. That is what you are told in additional information number 1. So meaning that Safari and Upia were present in the entire year. So they were not acquired during the year. So they were acquired at the start of the year and the previous period. So in the current year, when we are preparing our books, they were present from the start of the year until the end of the year. So the examiner was in need of just group statement of financial position. So Mwanzo is the one who is consolidating the other companies. So you say Mwanzo Limited, group statement. So group statement of financial position. Group statement of financial position. As at what? 30th September 2017. So shillings in thousands. So we start by consolidating the non-current assets. Non-current assets. So for the non-current assets, we talk about the first item being property, plant, and equipment. So remember, when consolidating these, you take the parent plus subsidiary. 7960 plus what? 7960 plus 4600. You know that we don't add what? We don't add associates. But we account for the associates using which method? We account for the associates using which method?
Equity method.
Equity.
Yes, we account for them using equity. So for this one, it's just 4 things I have to check if they are present. The first one being revaluation, which was present according to note 2. You were told that there was a revaluation of land, whereby they said that as at the date of its acquisition, the fair value of Safari Limited's net assets were equal to their book value. The fair value of the net assets were equal to the book value, with the exception of land that had a fair value of 400 in excess of the book value. So there was revaluation of land. So we add revaluation, because revaluation you debit PPA, you credit the revaluation reserve account. But the next thing now you have to do is all about you minus depreciation undercharge. But now the funny thing you can do is to depreciate land. Remember, this is land. That is why you are not given any percentage of depreciation or the remaining useful life. We don't have to depreciate the land. So it's just revaluation we have added. There is no depreciation of land. Then if there was a UPFA, we minus due to the sale of fixed asset. For now, we add depreciation overcharge due to the UPFA itself. We don't have UPFA. These arises due to sale of fixed asset. Were expounded in the videos I have done. Were expounded for the questions we have been doing. So patents, that is the next non-current asset. 500 plus 840. 500 plus 840. The next, investment in Safari. Investment in Upia. So investment in Safari, we do what? We check for goodwill for Safari. For the Upia, we say investment in Upia. Investment in Upia. This one we have now to use the equity method. So we do the working using equity method. We have to account for this using the equity method. So investment in, we have investment in Upia. So we do the working. Then there's other investments. So this one we have to record. Other investments. So for the other investments, parent plus subsidiary, 300 plus 400. And obvious, make sure that the investment which is provided in the additional information is the same as the investment which is in the statement of financial position. And you can see it's the same. You can see it's the same. These are a sitting question, which I did, which I don't have to do again because you have the recording. I said you watch that question for consolidation. So Safari and Upia, you can see the investment is 5,000 and 1,600. And in the additional information, you can see it's the same thing which is provided, which is okay. If there's any deviation, that is when you go ahead and record the difference as other investments. So after non-current assets, we go to the current assets. We go to the current assets. So for the current assets, we have inventories. So for inventories, parent plus subsidiary, 1140 plus what? 800. So we minus UPS. We minus what we earn. Do we minus UPS or we add? Which items do we adjust under inventory? The two items we adjust under inventory is UPS and. So this one we have to deduct. But now remember that the UPS I have to minus here is the one maybe if Safari, for example, sold goods to who? Let's say if Safari sold to Mwanza or Mwanza sold to Safari. Any transaction with Upia, this is an ungroup member. This is an ungroup member. This is an ungroup member. We don't have to eliminate. Are we together? So meaning that according to additional information which is provided in that question concerning the goods which were sold, who sold to who? According to note 4, it's Upia who sold goods to Mwanza. So that one is irrelevant. It's a transaction with a non-group member. So that UPS which could have arisen through those goods which were sold from Safari, from Upia to Mwanza, we don't have to eliminate here. that additional information is irrelevant. So then if there was goods in transit, remember that we could have recorded them by increasing our inventory and increasing our payables. These are goods which were sold on credit from one company to another, but that other company never received those goods by the end of the year. So the goods were received some few days after the end of this year. Let's say some 2 days after the end of this year. So we have to record those goods in the current year by debiting our inventory and crediting the payables. But there was no goods in transit, but now that is just a reminder that once you see goods in transit, that is what you are supposed to do. Then here there is receivable, the debtors balances, the receivables. So we have 840 plus what? 840 plus 760. So owings we have to minus, and there was that balance of the invoice of 100. So this one was outstanding balance, which was in additional information number 3. On 1st September 2017, Mwanzo processed an invoice of 100 in respect of an agreed allocation of management fees to Safari. As at 30 September 2017, Safari had not accounted for this transaction. So there was a claim for money. So, but before that prior to this, the current accounts between the two companies, current accounts is just the trade receivable and trade payables account. They were showing that had been agreed that Safari owing 140 to Mwanzo, included in trade receivables and trade payables. That is what we have eliminated. And at the same time, the invoice, the claim relating to management fees. And if there was cash in transit, I could have deducted here. Cash in transit, the amount which was already paid, which has not been received by the other company. The amount which was paid but not yet received by the other company, which was received, let's say, some few days after the end of the year. Remember that again, we have to record in the current year by crediting our receivables and debiting cash. When you credit the receivables, a deduction. When you debit cash or bank accounts, that is an addition you are doing to bank or cash. All right, so for the bank, there's a dash plus, so this is like 0 plus 300. So up to that point, we can see that we have total assets. Then after that, we talk about equity and liabilities. So for the equities and liabilities, you know that ordinary share capital for the ordinary share capital, you use the figure of the parent. You pick that of the parent. So the ordinary share capital of the parent was 4,000. For the reserves, I can see you are given reserves. Then the examiner is saying that they share premium under that reserve. So the share premium, again, you go with the figure of the parent. So the parent is 2,000. Then for the revenue reserve, revenue reserve is like retained earnings. This one we have to do a working. Revenue reserve is like the retained earnings. This one is a working which is supposed to be done. Then now we have to introduce non-controlling interest. We have to introduce the non-controlling interest, which we have to do a working. So the non-controlling interest we have to introduce so that we check the capital of the minority shareholders, the capital of the minority shareholders. So non-current liabilities, do we have non-current liabilities? So for the non-current liabilities, we check for the deferred tax. We check for the deferred tax. So this is again 400 plus 0, because under subsidiary there is nothing. Current liabilities. So for the current liabilities, we have the payables, trade payables. So for the trade payables, we have 1,500 plus what? 900. Then here we minus the owings, which was 140. The owings. And if there was goods in transit, I'm supposed to add here. The same I added in inventory, because adding here is crediting. Adding on inventory is debiting. And for the current tax, $280 plus 0. Bank overdraft. For the bank overdraft, it's 160 again plus 0. So here we have total equity and liabilities. Total equity and liabilities. So 7960 plus 4600 plus 400. 12,960. That is what you have from your end. 500 plus 840. This is 1340. Then goodwill of Safari, we have to do our working. This one are working. This is 700. 1140 plus 800. 1140 plus 800, that is 1940. Then 840 plus 760 minus, so this is 1360. Then this is 300. Then this one and this one are working. This is 400. 1,500 plus 900 minus 140. Here we have 2260.
Mwalimu, I have a question.
Yes, go ahead and ask your question.
The 140,000 owing to Mwanzo is included both in payables and receivables.
Yes, you deduct in receivables and payables to disregard them. You credit in payables. You credit in payables, or you debit in payables, and you credit in receivables. So remember that when I minus under receivables, I have credited. When I minus in payables, I have debited. So it's not just a debit, it's a debit credit. In order to forego them. There are not supposed to be any outstanding balances for those two. companies which is supposed to be carried forward in the next financial year. So for goodwill, you know that it's all about purchase consideration minus net assets acquired. The net assets acquired. So who is doing this goodwill? Obviously, we are doing the goodwill of Safari. Who is doing this goodwill? Mwanzo. Using which method? Full method. I said you can do in a shorter manner and or you go through the wrong process. In the shorter way, how do you go about it? You talk about purchase consideration. The purchase consideration being, if I do in the shorter way, the purchase consideration is for Safari, it's 5,000. Add the fair value of NCI. So the fair value of NCI is not 1,500. You raise net assets. So the net assets, you know, it's ordinary share capital, share premium. For the reserves, to be specific, revenue reserve and the revaluation reserve, the two, they have to be as at acquisition date. Like now we have ordinary share capital, share premium. There was a revenue reserve. There was revaluation. There was revaluation reserve. And there was a revenue reserve. So when talking about these two, the figures you use, they have to be as acquisition date. When this company was, when this company called Safari was acquired, their revaluation reserve was, and revenue reserve was. So ordinary share capital and share premium, they are direct from the statement of financial position. The 2,000 and they are 1,000. For the revaluation reserve, remember according to note 2, as at the date of acquisition, that revaluation was 400 for land. And revenue reserve, according to note 1, the retained earnings is the same as the revenue reserve, I said. The retained earnings of Safari, 2,400. So you can do this way. Your answer would be goodwill. 5,000 plus 1,500 minus 3,000 minus 2,800. So this is 700. That is your goodwill. The other way you can decide to separate. So you know from our previous questions the way I've been doing. But in our last question, I also showed you that you can do this way. So goodwill 700. Obviously, if goodwill is impaired, remember that we have to subject it to an impairment. If you are told a certain percentage, you multiply with this, you minus, you get 700. You are net goodwill. So there was no impairment. There was no impairment, meaning that this is my goodwill. So we go to the investment in UPIA. We do using the equity method. We do it using equity method. Next, we talk about investment in UPIA. So investment in UPIA using equity method. Using the equity method. So equity method, we recognize the associate with the initial cost of investment. After recognizing it with initial cost of investment, we add the share of post acquisition. So we can talk about retained profit and reserves. Then we raise impairment loss. Initial cost of investment. The cost of investment was for UPIA. For UPIA, it was this one here. Cost of investment, 1,600. 1,600. So for the post acquisition, to get the post acquisition, you always take the balance carried down. Balance carried down minus balance as acquisition. The balance carried down minus balance as acquisition. Remember that the balance carried down is the balance as the time they prepared the statement of financial position. The statement of financial position is obviously prepared at the end of the year. So meaning that here I will say 40%, because it's the share, 40% of the balance carried down of the retained earnings from the statement of financial position is for, remember that we are talking about UPIA. So this one, revenue reserve, 24. Remember, revenue reserve is the same as retained profit. So we have 2,400. That is the balance as at the statement of financial position. That is as at the end of the year. So as at the time they prepared the statement of financial position, 2,400. So the retained earnings as at acquisition date is this one, which is here, 1,600. So you minus. So 2,400 minus 1,600 times 40%. 2,400 minus 1,600. Times 40%. This is 320. So for reserves, we don't have the relevant information. We don't have the revenue. We don't have the revaluation reserve. Remember, we don't have the revaluation reserve in the statement of financial position. When I talk about the reserve, I'm talking about the revaluation reserve. I don't have it in the statement of financial position, so that I take the balance carried out minus the balance of such acquisition. And for impairment, it was not there. Even if our goodwill was present, yes, but we never impaired that goodwill. So this is 1920. That is what you put here. Then, now we have only two workings remaining: the revenue reserve and the NCI. The revenue reserve and the NCI. So we can do NCI, then we finish with the revenue reserve. So the non-controlling interest. So this one I have to use a T account. So when we are talking about NCI, under Safari, remember that on the credit side, we always do what? We always start with net assets. So we have ordinary share capital. I remember we have share premium. We have revaluation reserve. And we have a revenue reserve. So let's say that this is revaluation reserve. And this is revenue reserve. So remember that here we have to use the percentage, which is 20. 20% is the unacquired percentage in Safari. 20%. So 20% of the equity items. So let me use the first paper. So 20% of ordinary share capital here we have 2,000. We have 1,000. The revenue reserve is the one which is 3.8, and this one was 400. So 20% of 2,000, 400. This is 200. This is 80. %20 of 38. This is 760. So those are the net assets. Then you include goodwill of NCI. Goodwill of NCI and the depreciation overcharge. Now here is a challenge. Here is where we have a challenge. When we did goodwill, we never used the other method so that I know the goodwill of NCI. But you know that it's very simple to get the goodwill of NCI. You remember when we were doing our goodwill, if I was to separate that goodwill, say I was to check when I was doing goodwill, these are working I'm doing here. I could have said parent and NCI. So cost of investment was 5,000. The fair value of NCI is, it was 1,500. Net assets, the total value of net assets. Remember that we were having ordinary share capital, which is 2,000. Share premium, 1,000, so that is 3,000. Plus retained earnings, we said we use as at acquisition date according to note 1, 2,400. Plus what? Revaluation reserve according to note 2 for land, 400. So this one was giving us 3,000 plus 28 is 58. So I could have shared. So I could have shared 80% of 80% of 3 and 20% of not the 3 but 58, because that is the total net assets, 58. So this is another way I could have computed goodwill. So this is 4640. And the 20% of 58, 1160. So 5,000 minus 4640. This is 360. 1,500 minus 1160. 340. You can see it was giving us the same 700. So now I am in need of this 340. Goodwill of NCI. And there was no depreciation overcharge because there was no sale of fixed asset. This arises due to sale of fixed asset, whereby first we have to compute what? UPFA. Because if one entity sold a fixed asset to the other entity, Then this entity which sold this fixed asset made a profit, which the other entity will never realize, because that other entity will never do what? Resell that relevant fixed asset. So meaning that since it will never resell it, it will never realize the profit the seller realized. So meaning that the seller's profit is overstated by what the buyer never realized, because he never sold that fixed asset by the end of the year. So that is why we always compute for the unrealized profit on fixed assets, which is adjusted under the retained earnings and under the property, plant, and equipment. Then due to the intergroups of fixed assets, you will find that both group members subjected the asset to a depreciation. That is why we say they did a depreciation overchange, and that one understated the value of the asset and at the same time profit. That is why we have to compute for depreciation overcharge, then we adjust accordingly. And it has to affect the NCI part, because the parent never controlled the subsidiary 100%. You will find that it's not an 100% subsidiary. I've never seen where the examiner tests and tell you that the subsidiary was acquired 100%. If he does that, that question will be a walk. There would be no aspect of NCIs and so on. So it would be just be adding and giving the answers. Maybe in academic, not in professional courses. In the academic courses, they do that. So what am I supposed to debit here? UPS. If it's an overcharge here, depreciation undercharge, which is due to revaluation. But the revaluation of other assets, not the revaluation of land. Remember that we were having revaluation of land. We cannot depreciate the land. Then here we talk about impairment. Then there was that management fees. It has to affect this NCI. This amount was not yet recorded. So the 20% of the 100, which was concerning an invoice, which was outstanding, that is according to note 2. 100 in respect of an agreed allocation of management fees to Safari. So there was 20% for NCI. So UPS, again, remember that even if there was goods sold, they were sold by UPIA. We said we ignore that. The impairment is not there. So this is just 20. So meaning that 400 plus 200, 400 plus 200 plus 80 plus 760 plus 340. That is 1780. Yeah? So we have 1780. So the balancing figure is what we record there. The balancing figure. So that is 1760. That is what was missing here. So now it's only this which is remaining. Revenue reserve. So you have seen that the workings we have done is this one. This one you can get it. Even this you can score. So maybe the one which are a bit difficult sometimes are these two, but this one also you can get it. And this question was having how many marks? You know how the obvious mark, 14, 14, even if they decide giving you 1 mark, 1 mark, because they cannot give you half. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. So even without these workings, I was checking, even without these workings, these 4, this question you will have scored 13 out of 14. In any question of consolidation, it's very easy to get your 90% in that question. So let's do the retained earnings. And why am I doing more questions on this topic? Because obviously it's in your exam. It's a compulsory question in any exam. It has to appear in your exam. It's the same way published. They have to test published. And nowadays you realize that published, so you know how they test published. It's either they ask you statement of profit and loss, and a statement of profit or loss. Statement of profit or loss, and a statement of financial position. So they can test this, or they test cash flow. Sitting, they tested these. So when they test the statement of profit or loss and the statement of financial position, they don't test cash flow. But if they test cash flow, they don't test this. So those are the three areas you are sure you have in an exam 40%. Ikienda chini kabisa ni 35. Those three areas: group and the published. And nowadays, you know that they have to test, it's a must. They test financial analysis, the new topic. Either they test ratios or a common size. Sitting, they tested common size. So they might test ratios, but you have to know. So this one, again, it has to be more than 10. So already you see in 4 areas, which you are sure already, the topics you can read already, if you get around 10 out of the 45. Those are 2 questions. Because all of these, they can test 2 questions. Get that. Then the other remaining questions, you can miss 20. Because obviously in any exam, there's one very easy question from the small topics. Like in our assignment, there was a topic of provision of funds. And kuchukua tu incomes, unatoa expenses. Unaenda kwa statement of financial position, unapanga hiyo. Non-current asset, equity, non-current liability, current liability. You have your 10 marks. Anyway, let's finish this question. So what I was trying to say is that FR is not something to read as if you are reading a storybook. There are topics you are sure that they are in an exam. So make sure that you specialize on them. Not a must that you do everything in the syllabus. Yes, of which by the end we will cover everything. But on your side, for you to pass this paper, there's no those topics you need to be sure of. So if you are sure of doing some questions in some topics in a very genuine way, perfect, and you are sure that they are in an exam, there's no way you can fail. There's no way you can fail. Sasa kama kuna group, ukianza group ujui, ukienda published ujui. Sasa utajua gani? Because even the examiner when marking now, hata akimark zile zingine na theory, it's hard to pass without you being aware of group accounting and published. And the third topic I have said is financial analysis. Because anyway, that is a financial reporting. What are you reporting? What about the statements of an entity? And these statements are obviously reported under what and what. Mostly a question of published. Published is obvious in any financial reporting paper, even if it's in advance financial reporting. Because in advanced financial reporting, they make now cash flow to be compulsory, and that is a part of published. All right, so retained profit. So this one I will do it somehow in a direct way. So Mwanzo, Safari, and Upia. So I will start with it's a retained profit, or they call it revenue reserve. So usishindwe hizi natoa. So in the statement of financial position, we have a revenue reserve. Those are the one we start with. So the revenue reserve, according to my question here, is, I can see it's 9,000. We have 9,000. We have 3,800, and we have 2,400. So these are the retained profit or revenue reserves at the end of the year. But remember, we need just, as the parent, we need those retained profits for the current year only. So these are for by the end of the year, meaning that from the time those companies were acquired and the parent itself, this is what they have been retaining. But for now, we are doing the consolidation of this year. So what I will do, I will check, as at the time these other companies were acquired, their retained profit was stated at what value. I deduct from these figures, because those retained earnings for Safari and Upi, as at the time they were acquired, they are included here, because these are figures by the end of the current year. So we have the retained profit as acquisition. That is according to note 1. So as acquisition there in note 1, we have 2,400. So we deduct, so that we get now the retained profit for the current year. 24 and 16. Then again, there was that management fees which we need to raise, which was a claim. In regard, that is what they said in note 2. In regard, in respect of an agreed allocation of management fees to Safari. So we have 9,000. So 38 minus 24 minus 100. So this is 13. 2,400 minus 16. This is 8. So the retained profit for Safari and for Upia, the parent will take 80% from Upia, from Safari, sorry, and 40% from this. So we have 13 and we have 8. So we have 320. For 80% of 1,300, it's 1040. So now we add with what the parent itself retained. So these three must be added together. So 9,000 plus the one from Safari, which is 80% of this, plus 320, the one from Upia. So this is 10,360. So that is what you record here. So try balancing so that we check if it's okay. But in your exam, never waste your time adding these totals to get total assets and total equity and liabilities. Even if you balance them, they will earn you 0 mark. They don't mark totals, they mark the entries. That is why when you go to an exam, you will find that a student is done within 2 hours. You can finish a file with 2 hours. So you worry, how does this guy has done this paper? So it's not all about doing a lot of working. So you can get this 14 without those many working. So the total assets is, because you have remained very silent from the start of the session, what is your total assets?
20,520.
20,520. But on my side, if you can be able to, this one cannot be, mine is 21 to 20. Jacob is confirming the same. So 21 to 20. So you can check what you have not recorded. It's supposed to be this.
Yes, 21 to 20.
For equity and liabilities.
Mm-hmm.
So meaning that it's okay. So 21 to 20. So that is how you were supposed to do this question. That is how you were supposed to do that consolidation question. Yes, Kevin, never waste your time balancing. That is how you are supposed to know. Never waste your balancing the question. The examiner doesn't need your balancing. You need to see at least you have done entries. So going ahead to open accounts, because you would find that there may be, because I know there is some students here maybe who have attended elsewhere, classes elsewhere, and they never made it in that relevant city. So you will find that other, or maybe other lecturers, they can find, you will find that in PP, what they do, they open an account, an outside account. They move to, most of the accounts, they open a T account, even books. That is what books do. Opening T accounts and so on. Those T accounts you open, they don't have any mark in an exam. As a marker, I will mark these entries. So meaning that you are wasting time doing it. Those are T accounts. So it's better you go direct. That is why I am doing this. Even most of the marking schemes I have shared to you guys, you realize that Casname, that is how those marking schemes are prepared. You have them. Yeah. So how many questions have we done so far? Plus the one I shared for a sitting, the one which is solved, which maybe if you have watched, you have seen how it's supposed to be done. How many? 5 for this topic. I shared those links today. One, two, three, four. Yes, it's so there were 4 plus this one is 5. I don't have to waste time to do another one. So what if, Jacob, you are saying, what if Safari was a 6-month subsidiary? So Jacob, under the statement of financial position, even if the subsidiary is acquired 1 month to the end of the year, we don't apportion these items. We don't apportion transactions of subsidiaries. We don't prorate them, even if the subsidiary was existing for 1 month. Statement of financial position is prepared as at the end of the year. So we consider the full amount for that subsidiary, even if it was existing for 1 month. But now, the aspect of months will have use, will be of importance if I was to do an income statement. An income statement is prepared for the year. So if the subsidiary is acquired 6 months to the end of the year, and you are doing an income statement, the transactions of that subsidiary, they have to be prorated for the 6 months. So let's say like now this one was revenue. These PP figures were revenue. So to consolidate this revenue, I could have taken 7960 plus 6/12. That is when these subsidiaries it's existing for 6 months. So to consolidate my revenue in the income statement, I have to prorate. I have to prorate the items of that subsidiary. But for statement of financial position, you just take the full figures. Another concept I would like to tell you guys here, which is not in this question, but you might find it elsewhere. Two concepts I have to clarify. Is concerning purchase consideration. Purchase consideration. So purchase consideration, you will find that a company is acquired today. Then immediately on the time of acquisition, they paid cash, let's say 10 million. They issued shares, the parent issued shares. Let's say they issued 40 million shares and each share was going at shillings 1. So you get your 40. Then, remember that I have said the company, the relevant subsidiary was acquired today. So this is October. Or let's say by the relevant subsidiary was acquired in January 2022. So that January 2022, when they acquired the subsidiary, they paid cash. They issued shares, the 40 million shares, each going at shillings 1. Then, after 3 years, they told the parent said that they would add something in top of this. Let's say they will add 50 million after 3 years. So that is the end of 2024. They want to add 50 million. So this one, we call it a deferred consideration. So they deferred. So they deferred that instead of paying the 50 direct, they said they will pay after 3 years, after they have monitored the profitability of this company in the next 3 years. So in order to get now the purchase consideration in the present period, what am I supposed to do with the 50 million? You always do FM. What do you do with the future values in order to get the present values? You do what? Guys, you are not attending FM sessions. If you don't know this, it means that there's no FM, you know.
Discounting.
Yes, you discount. So which formula do you use to discount the future values to the present? Which formula?
Present value
1 plus R.
plus R raised to power negative N.
This is the cost of capital. This is the time. So 3 years, you will be given the cost of capital was, let's say, for example, 10%. In that question, you will be provided. Then the time, you know, it's 3 years. So then you multiply with that amount. So once you discount that, then now you get your total. And that will be your present purchase consideration. So the future values must be discounted to the present values. Are we together on that? There is a question which they asked that. For the other things were direct. But now if you could have missed this goodwill, you could have not scored. And let's say when they bring something of this kind, in the addition, in the requirement, they would ask you to do goodwill. Because they know there's a concept maybe you don't know. So future values, you discount to the present, then plus what they paid in the current year. Another concept, it's all about, you find that, let's say Mwanzo had acquired Safari, then Safari acquired, let's say now it was this way. So what they will do, they will say, for example, this is 80%. Then this one, they will give you 40%. So when doing a consolidation of this kind, in your level, they cannot make this one to be above 50. They would obviously maintain below 50. So meaning that when you are doing your consolidation, you will consider Safari at 80%. Remember that Mwanzo will consider this. Then again, Mwanzo will consider Upi at what percentage? So you take your 80 times 40. So this is 32. So meaning that Upia will be an associate, yes, but now an associate at 32. Then this one will remain to be at 80. So that is another thing you can find in an exam. So never be challenged that I never did something of this kind. So know that when consolidating the other one, which is down there, you have to take this, you multiply with this. Then continue. Obvious now, you know how to consolidate associates. Even if it's exactly 50%, you know that associates and joint ventures are consolidated the same way. The same way you consolidate associates, that is the same way you consolidate joint ventures. That marks the end of this session for today. What we have done is enough in consolidation. We meet on Wednesday, 8 p.m. I introduce a partnership. We do questions. And remember that currently for partnership, what we always do is only conversion of a partnership to a company. Previous, there was the aspect of dissolution of a partnership and amalgamation of partnership firms. That one was scrapped. So currently we do only conversion of a partnership to a company. That is the work for Wednesday and Thursday. So you have notes. So the better thing you could do is you go through that notes. Then when we meet, we do questions for the conversion of a partnership to a company. Have a good night if there's no any concern.
Sir, let me ask you, since you've said we will treat the joint ventures as an associate, does that mean that when we are adding, tuseme kama it's PPE, we are not going to add it kama the same way tumefanya the associate one?
Yes, we account for it using equity method.
Okay.
So let's say after multiplying your percentages, this your percentage becomes exactly 50. So you know 50 is just a joint venture. When it's now 51, it's when it becomes a subsidiary. But I said for this down here, they cannot make it a subsidiary because now we will be having something called sub-subsidiary. So sub-subsidiary is in the advanced level. It can either be 50 or less. So you will be given one subsidiary in your consolidation equation, associate and joint venture. They cannot test the aspect of sub-subsidiary. So when you have associates and the joint ventures, they are treated same way. So once you understand one, also you know the other. And for the subsidiary, I think you already know how to do it.
Yeah.
All right, Sawa. Another question? So there's no question. Have a nice time. Revise, do revision. We'll meet next time.
Bye.
Bye.